University of Michigan Consumer Sentiment Index relapsed. So we're back into deep COVID and 08-09 territory in terms of this sentiment index. And it makes sense. It's that regional bank crisis. It's consumers saying, wait a minute, what's going on? Are we safe? Are we safe in our banks? That's a big one, right? And it was a big drop and a big surprise. The other thing in that report was consumers saying, I think inflation's going up. And I think one of the reasons for that was gasoline prices did go up. And the consumer is railing against price increases. And that's why we think a lot of companies are going to start cutting prices.
The White House and congressional leaders in the United States have struck an agreement to raise the debt ceiling, but lawmakers still need to pass it into law before the United States defaults on its debts. This agreement was made after weeks of negotiations and dire predictions of an impending economic calamity. Since the November 2022 midterm elections, when Republicans narrowly won a majority in the U.S. House of Representatives, President Joe Biden's Democratic Party has been unable to enact legislation on its own. This crisis and its resolution have been months in the making. Biden and Republican House Speaker Kevin McCarthy reached a deal that would suspend the debt ceiling for 2 years and set a ceiling on federal spending during that time. The U.S. dollar increased on Friday as traders debated whether the Federal Reserve should forego raising interest rates in June, after May's non-farm payrolls report revealed a surge in employment. The report showed that payrolls in the public and private sectors increased by 339,000 in May, far exceeding the 190,000 forecasts made on average by economist Paul by Reuters. May's increase came after an increase of 253,000 in April. In this video, Cathie Wood discusses the debt deal, monetary policy, fiscal policy, and different indicators of the direction the economy will be heading in the future. It would be good to pay close attention to the video as she fairly covers the various facets of the economic front. As you watch, be sure to click the like button, subscribe, and leave your thoughts in the section below.
We have a debt deal now that President Biden is going to sign. We're not going to have to worry about this until early 2025. They're taking this off the table for election year campaign season. And it makes sense. It's astonishing how fearful the market was of default, though. Credit default swaps on U.S. sovereign debt rose at its peak to 325. Now, this is the price of an insurance policy against default. So it went up to 325, and within the last few days, it's down to 10. So the fear out there was extreme, and the market is enjoying, the stock market, some of a relief rally associated with that fear going away. M2 officially now dropped 4.6% on a year-over-year basis in April. And we think that it will continue to accelerate to the downside. We think it'll be down 5% or more in May. I'll say it again. It is shocking to me that the Fed never talks about money supply. I was early in my career when Fed Chairman Volcker was focused on inflation, and all we talked about was money supply. So quite a big difference. So the question now is the Fed going to pause? And we keep getting different stories from different Fed governors and presidents and so forth. If you look at the two variables that the Fed has focused us on, employment, and you look at the headline numbers, including today's, we'll get into that in a moment, you'd say, no way are they going to pause. They're going to keep lifting rates. Employment is too strong. If you look at the details inside today's report, and maybe I will go through that now, you'll see that they may be having second thoughts. While the headline number, non-farm payroll, was up 339,000, I believe, much stronger than the 250 to 280,000 expected. Another number, which is actually a leading indicator of employment, but it's buried deeply into the report, is called household employment. So payroll employment is a survey of corporations. Household employment is a survey of households. The Fed is going to have some interesting statistics, we think, in the next couple of months. And it's mostly because of what happened last year as opposed to this year. It looks like the CPI is settling into the 0.1 to 0.3 range. The comparison from last year for May was 0.9, and for June it was 1.2. That's month to month. So we're going to be dropping off some big numbers here, and we wouldn't be surprised to see the number in July, reported in July for June, to be around 3%. And to give you a sense of that, a year ago, June, the number on a year-over-year basis was 9. So 9 to 3 within 1 year's time. And we think the evidence is brewing that that number is going to continue down and probably will go negative. And when the Fed recognizes that that is the case, as we believe they will, there are all kinds of leading indicators, which I'll share with you in a minute, then it is going to change its tune. And by that time, we're probably going to see more increases in the unemployment rate. So today we got an increase from 3.4% to 3.7%. And the reason was that household measure fell 310,000, while the labor force, so the people out there looking for work, actually increased by nearly 150,000 people. So that's a 0.3 of an increase in the unemployment rate. The other negative piece of news from an economic activity point of view was that the work week shrank by 0.3%. And that has a disproportionate impact. It doesn't sound like a lot. 0.1 hours equals 0.3%, but it is a depressant on economic indicators. And in fact, if you look at total hours worked in the economy, they have essentially been flat to slightly down now since January. So there are a number of employment-related indicators that are suggesting weakness, even though there are others, like the JOLTS index, job openings soared in the last month. Initial claims started coming down again. The Challenger job survey, that one showed that layoffs surged 287% year over year. These are layoffs of, they're reductions in force, so a layoff of a group of people at the same time. So we're getting all kinds of conflicting indicators, which is, again, typical at turning points. And you'll know I've been using that phrase, turning points, for a while now. And one of the reasons for that is it does feel like we've been through rolling recessions, housing and autos, 2 negative GDP quarters in the first half of last year. And so it feels like this is one heck of an extended turning point in the economy.
According to Cathie Wood, many businesses want to start lowering their pricing in order to attract customers. She also said that the ISM manufacturing PMI fell to 46.9 from 47.1 in April, indicating that economic activity in the U.S. manufacturing sector continued to decrease at an increasing pace in May. This reading was worse than the market forecast of 47. After reading this article, the US dollar came under fresh selling pressure, and the US dollar index was last spotted down 0.4% on the day at 103.82. What do you anticipate the market's response to the debt ceiling bill will be? Please share your opinions in the section below. Don't forget to click the like button, subscribe, and enable notifications. Thank you for watching.